Good morning, everyone, and thank you very much for joining me. This is the morning market review, and it is Monday. It's the 4th of December. My name is Russell Shaw, I'm a senior market specialist at FXCM, and my email address rshore@fxcm.com. Just going to go ahead and bring up our disclaimers, and we'll start off with a high-risk investment warning. Of course, going to keep this on screen for a few moments for you to take a read through. Okay, let's just take a look at our market commentaries disclaimer. Good morning, Raj. Welcome. Glad to have you on the webinar as always. Here is our references, MarketScope 2.0 and TradingView.com. We'll go straight through to TradingView.com. And just taking a look at the real rate. And on the real rate here, we've got the head and shoulders that we're just taking a look at just to see how it effectively plays out, right? Hey James, good morning to you, welcome. And what's interesting, this is the daily chart, and if we take a look at Friday's candle, it drops significantly towards that neckline. It's dropping towards that neckline, isn't that interesting? So not only are we in downtrend on the, not only in downtrend for the real rate, it's actually moving that neckline for the pattern to complete. Hey Kim, good morning to you. Richard, a pleasure to have you on the webinar as always. And what caused this? We had effectively Jerome Powell was speaking on Friday, and he did say that we are in restrictive territory, and the market is basically interpreting that as we're really at the end of the rate hiking cycle, and by and large, real rates coming down. We're going to have to see if it completes this shoulders, but real rates are trending downwards. And if real rates are trending downwards, let's take a look at the US dollar, because the US dollar is correlated to the real rate. So what we'll do is we'll just press the plus over here, and here's our US dollar. We'll just put this in at the new pane. Okay, and you can see that as the real rate moves down, so does the. Or just put in a correlation coefficient here. So just click on indicators. Just click on correlation coefficient. Just make sure that we are looking at the real rate to the US dollar, right? Let me just try to bring it up again. Just click apply. And we've got a extremely strong correlation, 82. So it's a positive correlation. As the real rate's coming down, so is the dollar coming down. Bear in mind that we've got to be very careful here, okay? Correlations do tend to change over time. So we don't want to get fixated on the correlation. What we want to do is we want to start looking at the macroeconomics, because if the real rate is starting to come down because of recessionary fears, we're in a different environment. We're not quite there yet. It's coming down now because inflation's coming down. That's good. That's good in terms of the correlation that we are interpreting. Okay, but we've got to just be very cognizant of the fact that the correlation coefficient is fluid. So you can see that US dollar coming down as the head and shoulders is complete a real rate. Let's go ahead and bring up the US dollar, and let's do a top-down analysis. Okay, hey Howard, good morning to you, welcome. All right, so here we've got the US dollar, measured against the 30-week exponential moving average. Just where did I get the 30-week exponential moving average from? It comes from Stan Weinstein's book, How to Profit in a Bear and a Bull Market. It's quite a yeah, cheesy name, but it's actually a terrific book. Book's old. I think it's from 1987, and it's really held its own. He uses a 30-week exponential moving average. For our purposes, I think it's okay. I have seen in another course I did a very similar methodology where the person was using a 34-week exponential moving average. Oh, we'll just use the 30. It's pushed down. It's pushed down through that 30-week exponential moving average. The 30-week exponential moving average we're using as a filter. How do we use it as a filter? The direction, is it pointing up? Is it pointing down? Is it flat? It's pointing down. So we've got an extra confirmation of weakness there. And then we've taken a look at that RSI and we put in a trend line. So there's two ways we're looking at the RSI now. We're looking at its position relative to 50. It's under 50, and we're actually looking at it cross below a trend line. So just an extra sort of impulse or impetus to the downside. And then it's only Monday, so the weekly chart has still got a way to go to develop throughout the week, but we are seeing some blue. We're seeing some blue on the US dollar. Let's just go down to the daily chart and see if we're getting a rally in a downtrend that is exploitable. So let's just go down to the daily. All right, so what we've said about the dollar on the daily time frame is it's a very ordered, the trend is very, there's an order to the trend. Lower peak followed by lower trough, followed by lower peak, followed by lower trough. There's a nice series of lower peak followed by lower troughs. That's really what we want to see as traders, because trading trends is much easier than trading anything else. Consolidation is much harder. So the fact that we've got this ordered trend here, well, it looks as if we're heading towards this lower peak here. We've got lower peak question mark. We are in zone 3. Zone 3 is our area of weakness between the lower blue, lower red. Okay, and we do have an RSI that is below 50. So the fact that it is below 50, well, there is some sort of negative momentum there as well. Given that, so I would say there is some sort of synchronization between the weekly and the daily. So we can go down to the hourly chart. Let's take a look at resistances. And well, let's take this guy out. I don't think we need it. We are at the central pivot. The key question to hold is the central pivot going to hold? If it doesn't hold, then we're moving to R1. This R1 looks like quite a thick area of resistance. So the R1 level here is something that I think we immediately need to turn our attention to focus on. Not to say that there's not going to be some sort of pullback at the central pivot. There seems to be a real congestion area at that R1. Now, we don't want to predict. I don't know if it's going to turn at central pivot. I don't know if it's going to turn at R1. The R1 seems to me to be right now to be a more compelling form of resistance. But what we want to see is we want to see the technical indicators react. So we'd want to see the exponential moving averages move down. Okay, we'd want to see the stochastic roll over and move down. If we don't get that, then it is money that's piling into the dollar. And if there's money that's piling into the dollar, then I'll pose this question to you. Does that mean we risk on or risk off? If money is going into the greenback, which is generally thought of as a safe haven, or we risk on or risk off? Risk off, right. So we might be tending towards a risk off day today. Yeah, exactly right. So if we are seeing money go into the greenback, then we're probably going to see money coming off of the risk market. So we can go through and take a look at the DAX right away. We can just see what's happening. Is the DAX futures down? We're getting the DAX out in about 10 minutes time. So we can just go through to the DAX. Okay, and it looks to be rolling over. Okay, it seems to be rolling over. So there is some sort of weakness sort of seeping in. But what I would be doing, okay, I'm just going back to the US dollar. We're not finished with the DAX. We'll come back to the DAX, but I just want to show you as there's money flowing into the greenback, you can see there is some sort of pressure on the risk market. But let's just go back to the US dollar. Okay, I just want to reiterate the point here that the resistance has now become compelling. Okay, now we look for the resistances to see if there's going to be some sort of a key reaction. If we do get the reaction, okay, and why are we looking for a reaction to the downside? Because the daily is suggesting that there should be a reaction to the downside. Because the weekly is suggesting that there should be a reaction to the downside. Does it guarantee reactions? No, that's why we're not predicting, we're reacting. Okay, so we go back now to the DAX. Hey Mia, no worries, welcome. Pleasure to have you on the webinar as always. All right, so let's take a look at the DAX. We'll do a top-down analysis here as well. So you can see it's above 30-week exponential moving average. Use that 30-week exponential moving average as a filter, nicely pointing up. You can see that the RSI is above 50. I'm going to add a trend line here actually, just to show you sort of a breakout there. Not nice moving. Generally, let me just explain to you these trend lines because they're relatively new in terms of using them on the webinar. I just went back to some notes and I was going through the RSI, and one of the ways that you can use the RSI is to look for trend line breaks. The note suggested that the trend line breaks are secondary, so they're not primary signals, they're secondary signals, so they're kind of warnings. So we've got a trend line break there, and that was just the warning that we're going to go above the 30-week exponential moving average, and the 30-week exponential moving average turned up. So go down to the daily chart, okay, and this kind of, in my opinion, is going to complicate our analysis. This is actually something that I wish we didn't see, but unfortunately we are seeing this overbought condition. This overbought condition here, to me, is dangerous, is risky. I don't like the fact that we're working with the stock market index that's overbought, because invariably that overbought condition has to correct, and if that's going to correct, it kind of disrupts the intermarket analysis that we're doing. So I'm not thrilled to see it, but nevertheless we have to deal with it, right? So we've got the DAX in zone 1. It's between the upper blue and the upper red. There is some red coming in, and normally I'd say, well, you're probably looking for some sort of dip in the uptrend. In other words, if the dollar hits that R1 level and reacts, yeah, then we can see some sort of movements to the upside. What we would want to see is we'd want to see the EMAs turn up and cross, and of course we want to just keep an eye on the stochastic. The stochastic here is actually in a really good position. It's in a really good position. The longer it stays above 80, you know, the higher the, not the higher, the stronger the momentum, the momentum. And I think I just want to make this. I just want to explain that as well. I'll come back to that in a moment. So some sort of dip in the upper trend here would be the ideal type of analytical sort of conclusion. What's the red flag? We've got this overbought condition. So overbought condition, if we can just get this to normalize, you know, then I would have more confidence that the dollar is going to react off of the R1 level. We might see dollar go through the R1 level. Why? Because we just might see this profit taking on the DAX to the point that the oscillator is telling us there is froth that needs to normalize. Does everyone get that? Because it does kind of complicate the analysis. Everything was flowing along smoothly until we get this overbought condition. This overbought condition is actually pretty much it's pretty much a a sign of the industrials. The industrials are frothy at the moment. So industrials have run hard. You go through to the Dow Jones 30, so go through to the US 30, okay? And you're going to see we've got an overbought condition here as well. So it's the industrials. This is the Dow Jones industrials. So some sort of normalization here is required. The problem is, okay, we are running into the end of the year. I just wondered, I ponder this aloud. I don't have an answer for it, but are we seeing the Santa Claus rally? And is the sort of so the Santa Claus rally typically says there is an optimism towards the end of the year. Sometimes there is tax transactions that benefit the stock market. I wouldn't say it's a hard and fast rule. I'd say it works just enough times to keep us interested, and there are times when it doesn't work. But the point is, if there is some sort of Santa Claus rally, when there is going to be a normalization, the longer that we stay overbought, the more vicious the pullback's going to be, in my opinion. So just be very, very careful that there is an overbought condition here that needs to normalize. Another place you can see it, we're not doing the crypto minute, and I don't want to get too much into cryptos, but there is an overbought condition on the weekly Bitcoin. Bitcoin just hit 40,000, you know, so there's froth in the market. At some stage, the froth on the risk side of the market is going to have to normalize, and we're going to see the longer we stay overbought, the more vicious that pullback is going to be. Which more influence, the DAX or the US? That's from Kim. I would say that the US indexes would definitely have more influence, Kim. It's not to say that the DAX doesn't have an influence. Of course, it's got an influence. My general thinking is kind of US kind of sneezes, the rest of the world catches cold, right? It's kind of I don't know the latest market cap figures, but a couple of years back, I looked at the total market cap, and the US makes up 50% of the market cap. And this was an old pie chart. At that stage, Japan was number 2, which I don't think it is. I'm not sure if the Nikkei is the next biggest, or the Shanghai is. I'm not certain. But in this particular pie chart, the Nikkei came in second at 2%. So we got 50% number 1, 2% number 2. I mean, that's a huge disparity. Okay. So I hope that answers the question. How do you know how long the overbought oversold condition is going to last? I don't. What I can say is that we can try and add other technical indicators to try and get a feel when the reaction is happening. One way that we can do that is we can look for reference candle reversals. So kind of if we get a something like this. If we get something like this, okay. So this is a reference candle. This is a reference candle reversal, and we get that while the RSI overbought. I think that's going to hold quite a certain amount of weight. Does it make sense? Another way to do it is you can just kind of maybe put in like trend lines. This is not really a true trend line, but I'm just saying maybe put it in like this. Okay, or you can put in moving averages, or if it slips from zone 1 to zone 2, you can kind of see when the normalization is taking place. It just seems at the moment we overbought, and not only are we overbought, it seems that there's a certain amount of exuberance that's keeping us overbought. Mia, does that make sense? I'm sorry, I can't be clearer than that. Just let me know if that kind of offers some sort of explanation. The next chart that we need to look at is gold. Gold is one that we have been focusing on now for I think a few weeks, and it's paying dividends. It's really powered ahead this morning, and we hit a high here of 2144. It has turned into sort of an inverted hammer. I think maybe you call this a shooting star, not quite. So it has turned into a bearish candle. I think that that really depends now if the dollar goes and hits that R1 and reacts off of the R1 or pushes through R1. If it reacts off of R1, then I would suggest that we probably get a little bit more bullishness on gold. But if it pushes through R1, the dollar, then we probably get some sort of pullback in gold. That wouldn't be surprising. Look where the RSI is. Okay, RSI is overbought. So some sort of normalization here. So we're getting to the stage now when I think there is going to be profit taking. I don't know what kind of media headlines are going to be, like as if the headlines may be negative. I don't think that they should be negative. I think that's going to be normal profit taking. And then we can start looking for dips in the uptrend, rallies in the downtrend. When it comes to 2024, are we going to have a bull market? Are we going to have a bear market? It's a question that I've looked at articles where a number of the banks have a bearish forecast, a number of the banks have bullish forecasts. It's kind of like a split down the middle. What I think we've got to look at as traders are the recessionary fears starting to become more ingrained, or they're becoming more cemented. Then we probably switch towards a tougher environment. If the inflation is coming down but growth is resilient, growth is robust, then I think we're going to have a terrific 2024. I think I think it's going to be so. And Raj is saying keys to finding the dips in the uptrend for the US dollar. I'm not certain about that. I think more rallies in a potential downtrend, but that's kind of open, Raj. That's kind of open. It comes down to the real rate. See the real rate topping out, so I think the dollar might be topping out. Okay, so just be very sort of observed of what happens here, and be cognizant of the story. The story is very, very important here. Is the story because of a weakness that's starting to entrench itself, or is it because of disinflation that's coming down as per Federal Reserve plan? All right, that's as far as we go this morning. If there's any questions, go ahead and type those in. Any questions, please go ahead and type those in. All right, let's wrap up here. I want to wish you guys a good day ahead, good evening ahead, and we shall chat tomorrow morning. Thanks very much, guys. Have a great day.